Hello, I'm John McNair, Inspiratia's Head of Content, and welcome to another podcast from Inspiratia, this time on the topic of flexible generation and the UK funding landscape. Flexible energy generation will play a crucial role in balancing a system with increasing amounts of intermittent renewable power. But the rollout of battery storage and gas peakers will require a substantial amount of capital. And as it stands, only a few market players have got their heads around the complex revenue streams that come with these technologies. Most of the assets today are being funded with development equity, but structures involving asset finance or alternative lenders are emerging, and there will inevitably be project finance opportunities at the more contracted end of the market. To discuss this funding landscape with me today, I'm delighted to be joined by Gareth Baker, who's a partner at Gowling WLG, and Tom Williams, who's a partner at Gowling. Well, good morning to you both. Gareth, perhaps if I start off with you, just interested in how you would characterise the funding landscape for flexible generation today, and secondly, how does that compare to, for instance, the early days of solar and wind in the UK?
Thanks, John. So for standalone assets, which is the majority of what we see as opposed to co-location, I would divide the market into two. Battery storage is still challenging, has been for some time. What I believe is behind that, from what I'm seeing, is that as an asset class, we're still in relatively early days, and different types of capital are trying to work out the opportunity and how they can best participate in that opportunity, having regard to their need for a particular return profile and their appetite for risk. Peakers, in particular gas peakers, we've seen a great deal of continued interest and activity in development opportunities, and if anything, we saw a spike in the instructions coming through whilst the capacity market was at a standstill. And perhaps that was because of a belief in the opportunity and that market would come back. And of course that has proven to be correct, as we've seen very recently. If I was to compare it with solar and wind, I would say that it's certainly different. The activity that we were advising on, particularly in 2013 through to 2016, was either supply chain activity in the form of JVs, where perhaps panel suppliers or turbine suppliers wanted to help create the route to market for their kit, or a deeper pool of capital that was attracted by a mix of a straightforward subsidy regime and merchant power, but that subsidy regime smoothing any concerns around merchant power that they might have.
Okay, thanks, Gareth. And Tom, coming to you now. Gareth briefly touched upon the capacity market there, and as an investor, you know, that would seem to perhaps form one strand of a revenue stream. I mean, how do you approach these more distributed assets if they have perhaps uncontracted revenues or several different revenue streams?
Well, first of all, thanks very much for having me on. I think this is definitely my format. As my wife said to me this morning, I have a face for radio, so,
okay.
So I'm not quite sure what to take for that. How do we take these uncontracted elements? Well, look, I think it's very simple. I mean, we adopt the same methodology that we adopt for all of our other assets, you know, and it's very straightforward. There are a variety of different streams of analysis. Of most relevance to these assets is the analysis of revenue, which we break out into its constituent parts. You know, we first assess each revenue stream to determine whether fixed or variable, and what level of operational risk is associated with delivering that revenue stream. There are a lot of further levels of detail, like nature of variability. You know, variability has many forms. The thing that is interesting and challenging about these assets is that the variability of revenue is linked to volatility rather than long-term considerations affecting baseload pricing. So it is a very different scenario. You know, if we go back to what Gareth was saying about the differences between the early days of solar and today, I think there are more differences than similarities, despite the fact that actually many of the original solar developers are the guys that are playing in this market, and I think fundamentally that comes down to the nature of the revenues of the asset. I think in the solar days it was very clear that these once built, as long as they were built to a certain standard and they had the requisite documentation around them, they were clearly an investable asset, and there was no question about that. I don't think they were debt fundable when you started, but it was clear from where the wind market was that it was going to be that way. Really the focus was on building a high quality asset. I think in FlexGen, constructing the asset and developing the asset is probably even simpler than solar, and so the focus for me is really on who is going to own those assets and where the natural home for those assets is after it's been built and once it's operational.
Yeah. Okay, and I think we'll perhaps come on to who the ultimate owners of these assets will be in a moment. But first, I wanted to kind of pick up on the first part of your answer there. So you and I suppose the background to this is Gowling closed a fund in this area early at the start of this year. And you mentioned that you treat these assets much the same as many others, but just interested to hear whether your LPs look at it in the same way as perhaps a renewable generation asset, and how do you, if not, how do you kind of communicate the perhaps more complex economics behind these assets to them?
Yeah, I think the short answer is that the investors absolutely don't see these as similar to core renewables, and I think rightly so. I think you absolutely need to communicate the differences between the revenue streams and the nature of the risks associated with these assets. As I said, I think the simple answer is that it isn't as straightforward as core renewables. The revenue stack is much more subtle, it's much more complex. The way that we articulate investments in this asset class is to first of all start with the macro picture, and I think the macro picture is undeniable. There is going to be a need for greater flexibility in the UK's energy markets, and when you look at the policy statements that all of the parties have announced in this area, it's clear that the need for that flexibility is going to be unprecedented. People just simply don't know what technology is going to fill the gap. They know it looks something like a peaker or something like a battery or a combination of the two, but deploying that on the scale that people think is going to be necessary is going to be very, very challenging. What does that do? That creates opportunity. So having settled on the macro picture, then I think you start to look at the revenues of the assets. And as I alluded to earlier, these are layers of revenues, and these revenues at differing levels have different levels of risk associated with them, and are increasingly complex and increasingly harder to understand and quantify as you move up the stack. So you can start with a capacity market contract which doesn't take a great deal of understanding and doesn't have a great deal of operational risk associated with it, and then you can move through that into day ahead trading, intraday trading, different types of intraday trading with greater and greater degrees of uncertainty, lower and lower capture rates, and more complex discussions about how you capture value in those markets. What we're trying to do is work with people on the offtake side to simplify that story, and we have spent a huge amount of time and effort over the past about 18 months now trying to work up different solutions with different market participants to be able to persuade them that it's appropriate for them to take risk on the other side of the asset, on the offtake side, and then consequently de-risk the investment for our investors.
Okay. And Gareth, if we go on to the sort of development side of things and the equity behind that, I mean, in your experience for platforms, currently rolling out either pipelines and batteries or gas peakers, and the circumstances may be different, as you mentioned, for both those assets. What sources of development equity do you see as most liquid right now?
Sure. Well, I would agree that, again, we see different things for batteries and peakers. I just want to first of all echo a comment that Tom made about the macro need, because anyone investing in this space, do they have an inherent belief in the value of storage and the need for capacity as we move to more intermittency, and therefore do they believe in the sector opportunity? I think that's just so fundamental, really, to anyone who's investing. You talked about the most liquid. I would change that to are available, because in my experience, we aren't seeing lots of different options such that clients who are seeking equity are able to market a proposition and then perhaps use competitive tension in order to get certainty of pricing. There is definitely capital out there looking to invest. Whether that capital is well matched to the opportunity is a theme in this subsector, as I'm sure it is in others as well. Nonetheless, certainly in battery storage, we've seen some great businesses where they have gone through founder equity, they have gone through friends and family, and they're approaching that place where larger players are looking at them. Perhaps I describe it as sort of core plus money. And they will take some development risk. Maybe that's to secure a pipeline, or maybe there's an institution or a strategic investor who will come along. The other thing that we've seen a little bit of, which we didn't see in solar and wind, is actually the off-taker looking at coming in a bit earlier. Perhaps they want to learn, perhaps they want to secure route to market opportunities for themselves and exit later. So we're seeing that. I think the final thing I would say is under solar and wind, because of the subsidy regime, any tax incentives on the way in were quickly quashed. Certainly for the type of equity coming in at early stage, there are some incentives available, EIS type arrangements, and that can let's say help facilitate certain type of capital into this sector early on, and that will be a motivating factor for some people who are prepared to take that kind of risk on the opportunity at the early stage.
Okay. And Tom, from your side of the fence, keen to hear what kind of development equity you see out there, and picking up on Gareth's statement about there being very little competitive tension, perhaps. Is that what you're seeing?
Look, I think last year was a funny year, or this year just gone. Our experience of the market was that developers have been developing these projects, and as is necessary, they forecast a recycling of equity in order to fund future development activity. There are very, very few developers that are sort of indefinitely funded. With the suspension of the capacity markets, what happened was, yes, there was activity, but I'm not sure that was the kind of activity that necessarily those developers wanted to see, because I think it was more around a need for replacement working capital in lieu of a normal development cycle and a sale of fully developed projects. What we saw was projects changing hands at significant discounts to what had been achieved before. So we did see, and we were quite active in that market. And so that was quite a good period for us. The reason then I suppose why we were deploying capital into the space at the time was we did have a view on the fundamentals of what was required. We had a view on whether we thought the capacity markets would be reinstated that was more based on a fundamental belief of the necessity for flexible generation. The specifics of whether the capacity market was perhaps oversupplied and overprocured, I think, are playing out in what we saw in pricing this year and where we're seeing in terms of the market itself and how the market volatility responded to the suspension of the market of the capacity market, but also then in our view on where future auctions are going to come out. And in our view, that created an opportunity that was here and now in terms of projects which had CM16 contracts, CM15 contracts that were obviously cleared at attractive levels. Yeah. The nature of our investment has been both a secondary market, and it has also been greenfield development, and it has also been actually further back than that into the provision of working capital to certain of our development partners. So we've straddled, if you like, that capital spectrum. I think that does differentiate Dowling in the market because we have different pots of capital from different types of investors whose money that we manage that have specific risk requirements. And they're very distinct from one another. So we're able to put appropriate capital to work and appropriate risk-weighted opportunities. I think where other people are struggling a bit is that the asset class falls perhaps not quite in an infrastructure bucket. You might squeeze it into your core plus infra bucket once it's operational, but then before that, the operational in this world there's not much of a difference between construction and operation in terms of the risk that you're taking, I think, and the view that people take. And so really then it's about going further back and helping those projects be realised, which is more of a working capital play. Yeah. And that's where I think most people who are in that infrastructure investment space struggle. They struggle to have significant amounts of capital or even it's usually a mandate issue. And so as a consequence, I think it has been very difficult for people to find ways of deploying capital into the market. The people that you see that are doing that is the people who have decided that this is a sort of long-term sector for them. They've built up platforms and operational capabilities, and then they have really pursued development activity right the way through. And what they're doing is they are taking relatively conservative views on revenues, and they're trying to squeeze every possible cost they can out of the development and construction cycle, so that they can get acceptable returns from taking a more conservative view of those uncertain revenues in the future.
Okay, and with all this in mind, looking to the debt side now, I mean, we've seen a few instances in the battery storage sector of debt playing a part. I mean, I'm just keen to hear your view, Tom, on how much more of a part does debt need to play, if at all it does?
I think the problem that you have is that I strongly suspect that the projects that have been debt funded have been funded off the back of legacy FFR contracts, where there has been a long-term revenue stream associated with the asset. As we're all aware, that those are just not available anymore, and there is a very significant level of uncertainty at the moment about whether anything will replace those contracts in terms of ancillary services. And I wouldn't be investing on a case now that those contracts will be there in the future for any significant period of time. I think what that leads you then into is, what are you funding going forward, and where can I get my certainty of revenue from? It's possible for capacity market contracts for storage, and we have looked at those ourselves. But I think the main answer is actually what we've been focusing on heavily, which is a credit-worthy off-taker that provides a level of certainty within the revenue structure. Now, there are a variety of different ways of doing that and a variety of different durations that are possible. But we are making significant inroads into floor-style structures, where you just have a certain portion of revenues for what is now actually medium term. So we're seeing that originally we were at 3 years, we're kind of past 5 and into 7. You're not at the 15 years that you'd like, and you'd like to be amortising significant amounts of debt over, but it is making strides in the right direction, and we think there's still some way to go.
Okay. And Gareth, I'm just keen to hear your view on what you're seeing out there, and looking at I suppose bank debt playing a role in this sector, and how that's coming up against the reality of the revenues on offer. But then also, perhaps we can explore asset finance and what the role that's playing, or other kind of alternative non-bank lenders.
So, in terms of bank finance, first of all, mainstream and PF, there's been an inherent belief that project finance will move, because it inevitably has to move into this sector, and I'm just not seeing that at all right now, for some of the reasons that we've talked about here and that Tom has already set out. Maybe as the revenue, the visibility on revenue and floor pricing, etc., develops, that will change, but I'm just not seeing that happening at all. We are seeing activity from some of the asset finance houses who will look at anything that has some sort of revenue stream that they can back, and they are picking different elements of that revenue stream and are able to perhaps finance on a shorter term arrangement, whether that's FFR, EFR or something else. They are interested in doing that, and we've seen publicised interest from some of the alternative lenders. The likes of Gravis Capital have done some work in this space as well. I think the other bit that people are struggling with, as well as the revenue visibility, is what is my asset life going to be like? What's the residual value? And that is uncertain. Costs are coming down, not at the rate that we saw in the supply chain for solar and wind. Have we reached the point now where they aren't going to drop further dramatically? Well, we don't know that. And also, are we at a point where there's going to be significant step change in terms of the technology to make the earlier asset redundant and have no useful life? That's another risk that lenders are struggling with too. That's all in battery storage. In terms of peakers, certainly I would concur with the comments earlier that capacity market and other revenue streams, banks are just more comfortable with that. What we're seeing is development platforms are gradually refinancing perhaps some asset and PF style lending into corporate lends as they grow and commission more, particularly when they get to that sort of 100 to 150 megawatt number.
Okay. If we now perhaps move on to the M&A side of things, and Tom, firstly, I think it's good to touch upon Downing's recent divestment of Pivot Power to EDF Renewables, and just interested to hear your view on what EDF's interest in assets like that, that Pivot Power was developing, says about the motivations of groups like that in this area. And also, that deal had a an EV charging component or possibility to it. So how big a part did that play versus the batteries themselves?
Yeah, well, I think, first of all, I'm not entirely sure I can speak to EDF's renewables strategy, but what does it say? Look, I think EDF's appetite in Pivot is good proof of our market view on the need for flexible generation going forward. So I think it's a sort of ringing endorsement of the sector and a great signal to market and investors, as it shows our views are shared by others who who have a great deal of experience in the energy markets. So I think mainstream utilities taking up some of these opportunities is great. So we were obviously really delighted. There were a variety of other people interested in EDF, and that spanned in Pivot, I beg your pardon, and that spanned across the investor universe. From infrastructure investors right the way through to utilities. So it was one of those assets that did have a wide ranging appeal, I think the EV charging element did play a part in that. That it is a very topical discussion, and it's a very topical sector. There is obviously a huge opportunity with the way that the Pivot business is structured and the way that their connections are arranged for power, and making power available for charging is one of the biggest challenges that faces that sector at the moment. Yes, did it play a part? I'm sure that it did.
Yeah. Okay. Gareth, Tom, right at the top of the recording, mentioned, or raised the point of who will be the natural owners of these assets, and he's obviously kind of described utilities there, and also mentioned infrastructure investors. There's also oil majors and other different types of strategics. I mean, obviously it's difficult perhaps to say right now and put a finger on one of them, but how do you see the kind of ownership going in this market over the next few years?
Yeah, as you say, it's a guessing game, and I haven't brought the crystal ball with me today, but I'll have a go. I think first of all it's important to emphasise that some of the market making that happens or that is happening will naturally create preconceived exit points that will also need to happen. So I mentioned I mentioned off-takers taking an interest earlier. For example, we advised Statkraft on the Statera deal, and that's one of those ones where they've provided a route to market, and they aren't going to want to be in there forever. So Tom touched on types of capital, timeline and horizon. Inevitably there is capital in there that isn't patient, isn't long term. It wasn't raised in order to be that kind of capital. So I think I can predict that there will be activity. Who are the long-term natural owners? I suspect we will see some investors like we did in solar and wind, where there will be consolidation. I think there will be funds that do that. If you look at the existing renewable owners, they face an interesting challenge in that they've been very successful in consolidating subsidised wind and solar, and very successful at raising funds, but they're running out of things to buy, and therefore diversification is necessary, and that will either be geographical or that will be technological, and they will look at things that are complementary and closer to what they can do. So I think we will see, and it will be interesting to look at the way in which funds are going out and perhaps having a more flexible mandate to look at more. And I continue to be surprised at what I see is ostensibly pension fund money and infrastructure money, looking at having some small participation at the very early development end because they want to see and experience what it's like, and also maybe that can secure a long-term opportunity for them. But there's still a lot of capital that needs to be put to work, and it isn't going to earn the returns that are needed in cash or bonds or any other thing like that, given the low interest rates at the moment.
Yeah. And finally, Tom, your thoughts on that? I mean, who do you see as...
Yeah, look, so it's interesting. There's certainly a place for flexible generation in a diversified portfolio. That's for certain. And actually, I believe that that may be one of the ways of securing more favourable offtake arrangements, is actually to start taking on more of the balancing risk yourself and actually selling forward your portfolio as a whole. Nobody's really doing that at the moment, but it's a very, very interesting discussion. It's one that we've been looking at for some time, and it is clearly in the off-taker's interest to be able to procure that as a whole. And I think, continuing on that theme, there's clearly a place for this within utilities books to again manage imbalance, and there are again discussions that we're having about how we can help with our assets make some of our off-takers more competitive in their markets and their supply markets. So there is some way to go there, but there is a natural home for me then those assets within the utility envelope. What's really interesting is that we're seeing interest in this sector from a very wide range of foreign entities, specifically oil and gas and utilities, who want to learn from the UK's experience of the energy transition. I recently spoke at a conference in Japan. Japan is interesting because it has very similar characteristics to the UK in terms of it's an island, it's quite a developed economy, but it's at the start of its energy transition. And so you have very large vertically integrated utilities who feel that their core business at different points in the chain is under threat. And the evolution of the energy markets, the evolution of technology, and the move to a more through the energy transition is something that is causing them to take a great deal of attention about what's going on elsewhere in the world. And what's really interesting is that they seem to be focusing most of their attention on the UK as the market that they see as having made the greatest strides in that energy transition. That's not to say it's been painless or we're even vaguely where we need to be. But it is interesting, and it's seeing capital being attracted from those different markets to learn, to make solid investments, and then to take that learning back into domestic markets. So rather like Gad's response, I think I'm not entirely sure where this all ends up and in whose hands these end up. I suspect it's going to be a combination, and I expect that over time that will evolve, and I expect that returns will prove out, and people will get increasingly comfortable with volatility, and increasingly comfortable with people's ability to forecast volatility and to capture value in volatility. And at some point there will become an accepted view that is considered to be a lower risk than today. How far that goes and how rapidly that market matures will determine in whose hands these assets lie.
Well, no doubt be really interesting to keep track of that market as it develops. I think we'll leave it there for today. So Gareth, Tom, thank you very much.
Thanks,
Thank you.